and we will continue our discussion starting from last week, where I have broadly briefed you all in terms of what's the broader outset of the course itself, with clear insights into what you might expect in coming weeks in terms of our discussions, in terms of the areas that we are covering, and also in terms of importance of the program, not only for your course exam itself, but also in terms of how you might make use of the knowledge that you are gaining from studying a program like this. And if I'm not mistaken, I have covered up to slide number 20, and you all can see the slide in the screen now. If you see it, that's great. I mean, that would make you all easy to follow in terms of how we are moving ahead. And I have mentioned to you all very clearly in terms of relationship of money supply and also the price level. That is also one of the key areas of monetary authorities, if not central banks, that we are covering in this discussion towards latter part of the program. And then you have seen empirical evidence in terms of how different countries experienced across different time periods. And similarly, I have shown you the kind of relationship where the money supply and the inflation price level behaved, and to some extent the correlation between the increasing money supply and correspondingly inflation also increasing has weakened down. That means still there's a correlation, but what you are simply seeing is in recent years the strength of this correlation has come down. So still everybody considers money supply is a prime driver of inflation, but not necessarily as how the money supply has contributed to inflation prior to 1980s. So that's a kind of a very famous saying by Milton Friedman. Milton Friedman is not considered as one of the pioneers of monetary, if not economics branch of monetary authorities and central banks. So Milton Friedman has stated famously, the inflation is always and everywhere a monetary phenomenon. Inflation is always and everywhere a monetary phenomenon. So to say that he was concluding the continuous increase in money supply is a subject of inflation. And what this continuous increase in money supply is, you are invariably increasing the quantum or the stock of money available in an economy. But what you are simply seeing in nowadays with all these COVID-related developments, even the advanced economies, in fact, increasing money supply by many times, but unfortunately, you don't see an inflation. So inflation has been managed to a great extent, and they are facilitating the inflation management from various angles, and we will be getting into that area of discussion also towards latter part of this program. So to mention that, to continue our discussion, you already knows that interest rate, that is the price of money. So what it says is, if you are keeping currency in your wallets, that wallets, yes, you need that currency in your wallets for your day-to-day activities. And at times of precautionary motive, like during the curfew, if not COVID-related time, you might have kept more money than what you used to, right, to kind of meet unexpected developments. So to say that, what you are simply seeing is at times of precautionary requirement, at times of uncertainties, you hold more money than what you used to. So effectively, That means the money's ability to work for you has been taken out in such circumstances. If you keep anything in your wallets, if you keep anything in your the house, home, or even in office, in your cupboards, wherever, that money would not earn you anything, right? So if you invest these, even in the form of deposits, the price of money in such circumstances is the interest rate. So if you deposit, it's the deposit rate you are getting. If you invest in, let's say, treasury bills, treasury bonds, it's the interest rate. Similarly, if you invest in other financial assets, relevant returns would accumulate to the money stock that you are having. So the interest rate, very simply, you can call it price of money. I was referring to you rental of money last week. Yes, it's not different. If you rent a house, if you rent a property, you get a rental income. Similarly, if you rent a part of your money, you get an interest income. So interest rate is the rental of your money. Okay, so this relationship we were talking about, money supply and price level. Price level, when I say price level, please remember it's the inflation. So prior to 1980, this rate of money growth and the interest rates on many financial assets, you can call it in the slide, it's long-term treasury bonds, to kind of see a more close relationship, is closely tied. That means when the money growth is increasing, long-term treasury bond interest rates also increasing, right? But in recent years, this relationship is less clear-cut, but the rate of money growth is still an important determinant of interest rates. So if the money growth is substantively increasing, that indirectly kind of expose your economy to future price increases. That means future inflation. So if the future inflation is increasing, you expect, when you invest in long-term treasury bonds, the treasury bond interest rate also to increase. So that's the kind of a relationship. You have to see higher the money supply growth, higher the interest rate in that scenario. So this is a very important relationship that you are learning in terms of money and interest rates. And you might revisit this concept as we start discussing in our future discussions. I hope you are getting the picture in. Any clarification, any further insights you want in terms of the discussion? If you are not in a position to speak, please type it. I can see it in the screen, your observations, your comments, so I can quickly respond as we move on. And follow the lecture notes very closely, so that also would help you to kind of get a kind of a feel on what I'm trying to elaborate in the discussion. Okay, so moving to the next slide, you can see again the relationship I was mentioning, right? The money growth and interest rates movement. So the blue color line, I believe you can see it, that is the money growth. That means you might see it swinging higher growths, and then that means the growth is the height. It's not that this is the level. So you have already achieved 5 feet of your height. Growth is by another 10% mean 10 feet. It's not 5 feet 10%. So it is by another, you can call it half a feet increase. That's a growth here. Money stock growth, let's say 6% means if it is 100, so it is 106. So you can see blue lines at different period of time, the growth is visible at different rates. So money supply is increasing at different paces. But when you see higher money supply growth, correspondingly associated with higher the interest rate. It is very clear during the period of early 1980s. Okay, since then still money supply growth was significant, but you don't see interest rate is that significantly increasing. So that's again the relationship I was mentioning, somewhat broken down in recent years, but still existing. So this is US experience that we are talking, but similar circumstances is visible across other economies, other countries. So you can see this relationship across these countries, and also the relationship in terms of how the interest rates were behaving when the money growth was visible. So these were the areas that you will get into kind of a more detail as we move on. But heads up, I'm giving you all so you can kind of have a picture on these discussions. Then another area very important for our discussion is fiscal policy and monetary policy. You know, monetary policy is what central banks, monetary authorities is responsible of. Fiscal policy, mainly the treasury, if not the government. Okay, so there's a kind of a very a close correlation between fiscal policy and monetary policy, because any economy's direction is often defined by how fiscal policy and monetary policy is operated. Okay, but we would not necessarily get into greater details of fiscal policy in this course, but we will get a kind of a simple flavor in our discussions how the fiscal policy might influence the monetary policy and thereby monetary aspects in the economy. So when you see monetary policy, already as you are familiar with descriptions that we were having all throughout. So it is the management of money supply and interest rates. Okay, so this being done by central banks. In the case of US, it's a Federal Reserve. In the case of Sri Lanka, it's the Central Bank of Sri Lanka. In the case of Singapore, it is the Monetary Authority of Singapore. In the case of India, it is the Reserve Bank of India, right? So these are the kind of central banks that you are familiar to great extent. So they are, what they are basically doing is the management of money supply and interest rates in their economies, right? So when you see the fiscal policy, that deals with the government spending and taxation. So when you say your income tax being increased or decreased, the tax on goods and services, tax on petroleum, tax on gas, tax on mobile data, tax on telephone, if these things being adjusted, it's the kind of, matter to deal with fiscal policy. Okay, so when you see these adjustments being looked at by the governments, okay, that is to manage the government's expenditure against its revenue. So as a result of this, what you are simply ending up is the budget outcome. So when you see budget outcome, you might end up with a deficit where the expenditure is greater than the revenue for a given period of time. We usually say a financial year. Okay. At the same time, budget could be a surplus. What it means is a revenue is excess of expenditure. But it's very rare. You don't see a surplus budget in Sri Lanka except very few years, like 3 years, if I'm not mistaken, since independence. In advanced economies like US also, you don't see much of surplus budgets. Okay, but what happened here is when you see these deficits of budgets being looked at, these deficits need to be financed. This deficit needs to be financed through borrowing in the form of treasury bills, treasury bonds. This is a common form of financing by the kind of governments. So you can see, so these are the kind of processes you are familiar with when it comes to a deficit and the deficit being financed through borrowing by the governments. Then you see a kind of example again in the case of US across different periods until the 2010 slide. See the deficits. You mostly see the deficits, but you see surpluses also. In fact, towards late, if not latter part of 1990s and early 2000s, the US budget had significant surpluses, right? So since then you see deficits, but to great extent this deficit has come down very sharply to about 2 to 3% in recent years, but this year it would be again going back to close to 8% based on the numbers that we are now seeing in the case of US. And in the Sri Lanka's case also, you might see deficits is often the norm. So we see a deficit budget. So we had to borrow to finance the expenditure that would not be covered by the revenue of the government. So this is the usual pattern of most of the countries in the world, and that contributes to invariably a very important aspect of this course, the financial markets. So if you have a very sound and efficient financial market, you can finance these deficits much clearly and also much efficiently. So you can see this as we move on. Then you see foreign exchange market. This is also part of this program, as I was mentioning, but I doubt whether I'll be able to detailedly getting into this area of discussion, because most of my previous semesters also I found towards last few discussions we might not necessarily have much of a time to kind of cover, but if possible we also would touch upon the foreign exchange market. And the foreign exchange market is where funds are converted from one currency into the other. So you have Sri Lankan rupees, you wanted to convert that to a US dollars. Yes, this is the market where you convert this. Okay. So the foreign exchange rate in the foreign exchange market is the price of one currency in terms of another currency. Foreign exchange rate is you are expressing the price of, let's say, Sri Lankan rupees against US dollar. So 186 Sri Lankan rupees equals 1 US dollar. Okay. So similarly, 1.6 Sri Lankan rupees equals 1 Japanese yen. So it's the exchange rate. 1.6 or 186 that we were referring is the exchange rate. So price of Sri Lankan rupee in terms of the other currency. Okay. So this exchange market, foreign exchange market, determines the foreign exchange rate through supply and demand for the foreign exchange. So you can again see a market where the currency is being exchanged. So this is one area we will touch upon based on the availability of time. So then you see how the exchange rate was behaving in US. This is US dollar behavior expressed as a index where 1973 equals 100, where they have made 1973 this point in the chart, if you can see it. So that's the 100. So it's an index rather than expressing exclusively in terms of one currency to the other. So basket of currencies, they might have used it here. So 100, but then you see exchange rate is reasonably across this 100 tag all throughout. Okay. Here you see depreciation. Here below 100 is appreciation. You probably see US dollar is strength when US dollar is behaving below 100 when you see a index line, right? So in Sri Lankan case, often what we are simply seeing is the price, I mean the exchange indices, we tend to be in the other side of the coin. I mean our currency get to kind of depreciate regularly. So you can see that behavior if you look at central bank's annual report and various central bank publication, or you can go to the central bank website, you can see these details. So similarly, you can get into kind of international financial system. This we touch upon to some extent towards latter part of the course, because today everybody is integrated. Okay, even if anything happens in other countries, you can't expect that it's not felt in Sri Lanka. Sri Lanka's markets are felt when the other countries' financial markets behave. Okay, so this is why when the financial crisis exists, you find the difficulties in our economy. So we can conclude to say that financial markets have increasingly become integrated throughout the world, right? So you can basically see these international financial system are very important in today's context, as I was telling when we were talking about these deficits. So we had to raise finances, and the financial markets are very important. So you have to be a part and parcel of this financial market. So it's integrated. So when US dollar, or if not US markets interest rates changes, that has an influence on Sri Lanka's interest rates too. Similarly, when another market, like let's say India for that matter, or for that matter in the East Asia, where the interest rates changes, so you have an influence in Sri Lankan financial markets too, because people can exchange assets in Sri Lankan markets to other markets based on the integration of these markets throughout the world. And there may be some elements of control, like exchange control, but those are not fashionable in today's markets, where you don't see much of exchange control. So you may be able to take money out for investments. Similarly, the foreigners can bring their money to Sri Lanka and invest if they see opportunities and higher returns. So it's a common thing that sets out the markets to behave in an orderly manner. Okay, so in your circumstance where you also see cases like saving investment gap for countries like Sri Lanka, it's very important, right? So when your savings are not enough to meet your investments, right, you need resources from foreign markets. So the international financial system is the base through which you get these resources. So international financial system channel their excess funds to domestic economy, because we have a saving gap. So we don't have enough savings to meet our investments requirement. So Sri Lanka has a continuous saving investment gap. We need foreign resources to come in and bridge this gap on a continuous basis to achieve our investments needs. So to kind of have this international financial system facilitation to domestic economy, there are various elements play a very important role. How your exchange rate policy, okay, and monetary policy, it's very important for these investors. If you have a control, not kind of a free float exchange rate, the investors are worried how the exchange rate would be influenced by authorities without letting markets to determine. So that's a hindrance to get foreign investments to your country. And how free and independent your monetary policy, that's very important. So if you have a flexibility in determining your monetary policy, that's a very positive in terms of getting foreigners to come and invest. So similarly, capital controls, I was mentioning about exchange control a little while ago. So capital controls also impact domestic financial system and thereby the performance of the economy. So if you have control capital arrangement where you allow foreigners to come and invest in your economy, but when the foreigners wanted to go out from your economy, take their investments out from your economy, you don't let them, you control those. So that's not a good sign, that's an impediment, right? So then the international financial system would not necessarily facilitate for your economy to kind of bridge the so-called saving investment gap. So if you do not have this type of controls, they are much more happy to come in, and when they want, they can go out, right? So this is a very important area of discussion, and most of the countries now trying to kind of maintain the flexibility in terms of these financial markets. So they don't want to introduce controls. There's some element of management is there, that is fair enough, but not necessarily to control and not let foreign investments be freely moved in and moved out. Okay, so similarly, the role of international financial agencies, multilateral financial agencies like IMF. So what's the relationship you have with IMF? So that's also important, because IMF and all would help you to kind of firm up your financial markets, and also would help you to kind of build required market arrangements in line with best international standards of practice. So that's a very important element the international investors look at. So Sri Lanka had repeated programs with IMF. Even we are currently having an extended fund facility. We call it EFF, right? So that also facilitates Sri Lanka to shape up their policy environment, right? So these are kind of, elements through which international financial system plays a role in your economy. That's very important. You can kind of, take it out and not have this system being looked at. So it's very important that we have a close relationship through international financial system if you really wanted to facilitate your domestic economy, and especially for countries like Sri Lanka and developing economies where you have a resource gap. You need to get foreign resources to fulfill your investments requirement. So similarly, we see the program that we are now looking at, this monetary economics of monetary policy and financial markets. That's the course that you are looking at. How we will study this? We will follow a simplified approach to the demand for financial assets. So that's very important, because I would one by one move into this in terms of demand for financial assets. So you would kind of, refresh your micro and macro economics knowledge in terms of taking supply curves, the demand curves, and the equilibrium, that determines the equilibrium price or the equilibrium interest rates for that matter. So these are kind of, a basic supply and demand behavior that you have learned, and we would interpret into the financial markets to see how the financial assets price is determined. Okay, but at the same time, as everywhere, the search for profits will always work in this market, and the search for profits would again kind of, take care of any not equilibrium points. So non-equilibrium points to be kind of, ironed out and bring back to the equilibrium. So this profit motive is kind of, work in the favor of contributing to the market's efficiency. So you see this type of things in the entire program. Okay, so we will also look at financial structure, okay, based on transaction costs and asymmetry. Financial structure is the kind of, arrangement that we will start most likely towards first lecture itself as we move on today. So you might necessarily see whether you have a market-based, that means direct financial structure, or intermediary-based, that is an indirect financial structure. So direct market structure is the borrowers, if not people who want finances for investments, they directly come to the market and offer financial instruments like equities, that is stocks, or bonds, that is debentures in private bonds are concerned. So you offer and you kind of, directly get finances for your purposes. If it is indirect, that means intermediary based, means you basically go for a bank and banks will lend you. So that is like third party. So the bank is the third party, he facilitates you to get the finance. So in this market structures, very important two aspects is transaction cost and asymmetry. Asymmetry is not symmetry. But what it means is, asymmetric information means the parties to the market transactions do not process equal amount of information. Even if you have equal amount of information, your capacity and technical expertise would separate you to understand the information that's available in the market. That's why you have some people with expertise in accountancy, some people who are very good in financial analysis, some are economists, okay, some having engineering knowledge, different aspects, right? So this asymmetry is a very important element, because all what you see in terms of financial supervision and regulation in financial market is to reduce this asymmetry. They try to kind of make sure that everybody gets at least minimum required information in terms of assessing their investment decision. But at the same time, you see transaction cost. If the market is not efficient, you will see higher cost for transactions. In other sense, if market is efficient, you will see very little amount for transaction cost. So this is also important in this process. And also we look at so-called aggregate supply and demand analysis in determining market clearances in a kind of a simplified approach to demand for financial assets in the program. So this is how we probably be approaching. So this is how we will be moving in terms of this program. I have explained to you in greater details in terms of what's the textbook, how we would be covering our discussions, and your preparedness in terms of how you are looking at the financial press, okay, and also a kind of preparedness in terms of course material, following up with the notes and the presentations that we have sharing. So this would make you kind of prepare for your exam, and also this would help you to kind of prepare yourself to kind of see how best you fit in the modern financial markets and the financial sphere, not only as a professional, but also even if you do another profession, but still you might require to see how best you fit in with the financial market products. And also we would look at so-called the economics of monetary policy, where the role of central bank, how the central banks would present itself in terms of achieving objectives and related concepts. So we would be very simplified base through which we would be analyzing this program. So that's what I wanted to say broadly in terms of the introduction to this program, and I believe it's very clear. And if you have any further question, I'm very happy to answer. If not, we can move on to the next presentation. I believe you have already given the presentation slides by the IBSL. So if you have any further clarification, please feel free to kind of note it down so I can take up as I discuss with the course details. Right. So I hope you have this lecture number 2. Okay. So this is the financial structure, introduction to or overview of the financial system. So we are moving into that lecture today. So we would be covering in this discussion, right? So the financial markets, as I said, financial assets market, mainly the bonds and equities, and similarly financial intermediaries, as I was mentioning, banks, insurance companies, finance companies, leasing companies, anything that you call it, they engage in a financial related intermediary function, even the pension funds, right? So these agencies and these markets have the basic function of getting the general public like you and me together by moving funds from those who have surpluses of funds to those who have shortage of funds. Here, as example, I have mentioned Walter has surpluses and Peter has deficits. So what these markets and the intermediary is trying to do is they facilitate to move the funds with surplus entities to funds to shortage entities. So it's a kind of a function. You deposit, and these deposits being channeled to the borrowers, they have a shortage, right, in the form of loans by the financial intermediaries. If not, the market facilitate in the form of financial assets. So you invest your excess funds to equities or bonds. If it is private, it is debentures often being called. So you excess being channeled to those, and those funds being used by the agencies or the institutions in the economy to make use of their business projects. So this is how these agencies look at. So this is how broadly you see the market. So you have one element of the institutions, intermediaries, and then you have the so-called marketplace. So basically, this marketplace facilitates excess entities to channel their funds to shortage entities. Okay, so as an example, so IBM invents a better computer. Okay, it may need funds to bring it to the market. Not only IBM, for that matter, any inventor who wants to introduce a new product to the market, he requires investments. He might not have the resources, but he might have the brilliant project, if not product proposal and the product idea. So to make it a kind of, economic proposition, he needs resources. Okay. So similarly, when a local government needs to build a road or a school, the municipality, that's a local government, they want to build a road. Okay. It needs more funds than local property taxes we all pay. Local property taxes being used to kind of, maintain and clean up the drains and have garbage being collected on a regular basis and things like that. But to have a kind of a building and a related infrastructure being built or road being constructed, you need additional funds. So these local governments also need the support of the financial markets and financial intermediaries. So well-functioning financial markets and financial intermediaries, that's very important and crucial to bring this required stakeholders being met together, and then thereby facilitating the funds being channeled from excess entities to shortage entities, as we were discussing. Okay, so to study the effects of these financial markets and financial intermediaries of the economy, okay, we need to have some understanding on their general structure and its operation. Okay, so in this section, we learn about the major financial intermediaries and the instruments that are traded in financial markets and how these markets are being regulated. So this is the focus of this lecture that we are going to touch upon today. Any questions before I move on? Right, so there are questions in terms of today's lecture notes being not shared. So you will definitely get the lecture notes. Maybe IBSL might have not shared already, or my understanding is they shared through the email notification. If not, you will get it after the discussion. I will request them to share the course materials. So you will have much more clearer clarity by going through these lecture notes. But for the time being, you can follow me in terms of the discussion, and you can also take down important elements be noted. So that can be followed with lecture notes as you receive. So that would facilitate most of your considerations in terms of the material. So what I'm simply trying to say is the elements that we were highlighting in the financial markets, in a broader sense, the market is a broad term describing any marketplace, as you already know, where buyers and sellers participate in trade of such assets, right? And in this case, it's the financial assets that they are trying to trade. So you can kind of assume, like any other marketplace, this also a physical location, but it not necessarily in terms of today's infrastructure and the technology are concerned. This could be very much online, but financial markets is a broader marketplace where the buyers and sellers of financial assets not necessarily meet, exchange their financial products. Okay, so there are places, as I was mentioning last week also, you probably see Wall Street, very famous financial markets in the world. Similarly, London, similarly, Tokyo, right? So these were kind of, places very well established in terms of financial markets, global financial centers. And then you probably see in emerging markets, different places like Singapore and even Dubai to some extent, these are established, even Mauritius to some extent, establishing as financial centers, regional financial centers, right? So it's a marketplace to a great extent, but it's not necessarily, you don't need to physically be there. You can have all the access in terms of technology and infrastructure through which you can exchange financial assets. So it's a place through which you exchange financial assets. It not necessarily be a physical location. Okay, so when you see a financial market, it's not like other marketplaces, like your market for buying of rice, for market for buying of vegetables, market for buying of bread, fruits, whatever. It's not like that. Financial markets are typically defined by having very transparent pricing. So it's established a kind of a mechanism through which the prices are determined. So sometimes screen-based price determination. So you have a buyers, you have a sellers. So you ultimately end up with the prices being determined through a market process. So let me again speak to the IBSL and see if you have not yet received these slides. So while we are discussing, I'll also try to get hold of the IBSL staff to see whether they have shared this. Then it would be easy for you all to follow up in terms of lecture notes. 1 second, please. Yeah. Kavindra, other lecture notes share කරගෙන තියෙන්නේ. Right. ඒකේ supplement එකත් read supplement එකත් share කරගෙන තියෙන්නේ. Okay. Thank you. So I was checking with the IBSL and they are saying already the lecture PowerPoint presentation as well as the reading supplement is shared. So you probably have to access and see. If not, you can send them inquiry so they will be able to share the documents again. So it seems already they have shared the documents for you all to follow up. So when I say the markets, as you already know, the financial market, as I was telling, is defined by transparent pricing. So as I said, it's a screen-based pricing in most cases. You go to a stock market, you probably see buyers and sellers. Yes, they exchange, but remember, there are other possibilities also in terms of transactions being happening, like OTC. When I say OTC, it is over the counter, right? So instead of screen-based transaction, there may be other forms of transactions also, but they have a transparent basis of price determination. And then they have basic regulation of trading. You can't just be like, everyone can't come and trade in a financial market. Either financial intermediaries, or they have brokers or agencies, primary dealers. They have been responsible with making transactions through the established arrangements. And also you have a cost and fees defined in terms of different structures. Okay, and these markets are again determines the prices of these markets through kind of structured arrangements. It's well established, documented, and anyone can go through and kind of see how the market been facilitated. Why these are important? Because in the event of any dispute, the process, whether the process been established or followed, is very important to kind of determine and remedy. So financial markets are that much influence. And to give you more inputs into the financial markets and financial structures, you find a read supplement today. So that's a reading supplement. So it is available, and I have already shared that, and the IBSL is telling that is available for you all to share. So you can see greater details of a marketplace, how it's been defined. Okay, financial markets can be found in every nation in the world. Okay, some are very small with only few participants, but similarly the big ones like New York Stock Exchange and the other bigger markets where you can see trillions of dollars trade on a single day. Okay, so investors have access to these markets, or the definition of what is a capital market. Okay, there are different types of capital market: primary market, secondary markets. These details are there, right? So then you see the stakeholders, the government corporations, and different funds. So it's stock market, and then of course you see a definition in terms of bond. You have already kind of known these things. Okay, then you have a money market. Okay, when I say money market, it is the market in which it is also a part of financial market, but it's a marketplace or a market through which the short-term financial assets trade. Money market is a market which facilitates short-term financial assets to exchange. So when I say short-term, it is less than 1 year. Okay, so it's a market segment which financial instruments with high liquidity and very short maturities are traded. So that's the money market. So you get this. So then you see CDs, certificates or deposits. There are concepts here, various market jargons, market concepts. Cash or spot market, right? Then you have a derivative market. So similarly, Forex is foreign exchange and interbank market, right? So primary market was a secondary market. You'll probably see in the primary market, the issuer. For instance, if it is government bond, the issuer is the government. On behalf of government, it's the central bank issue. So in the primary market, you see one leg is the issuer, the other leg is the investor. Sometimes not directly by the investor, but through financial intermediaries like primary dealers. So in the secondary market, it is investor versus investor. Issuer do not exist. So these details are there. So this note is to facilitate, and also see the OTC market, over the counter, I was just mentioning. Not a screen based, but you see market transactions takes place through OTC also. Then third and fourth markets. So these are all explanation. I mean, this is like to give you some insights into the financial markets with little more clarity. So have this and read this. This would also give you some new knowledge if you are not familiar with some of these concepts. But it's very important to have some understanding, because we might repeat some of these names as we move on in our discussions. So that would make you easily easily understand the discussion, and also you feel much more comfortable in participating in the discussion. So you see this read supplement along with lecture notes, and you can follow on that basis. So if you move into the financial market, as we were discussing, so what's the functions of these financial markets? Okay, so this is a very important area. So functions of financial markets, they perform the essential function, very essential function, that is channeling of funds from economic players that have saved surplus funds to those that have shortage of funds. As we have already recognized, The very basic essential function of these markets is to channel funds from surplus entities to shortage entities. So remember like that. So it's very easy. Okay. So I was mentioning you the concept of direct finance versus indirect finance. So when you say direct finance, borrowers borrow directly from lenders in financial market by selling financial assets or financial securities. Okay. So you see here the borrower or the institution who wants money. For instance, the government, he wants money by issuing bonds. They exist, right? So financial markets would facilitate direct finance where borrower directly sell the financial assets to the investor. He's the lender here, right? So it's a direct finance. So company ABC, bank XYZ, they come to the market and they issue financial assets to the market participants, and market participants invest in those. So that's a direct financial arrangement. So it's a direct finance. So now onwards, if you say direct finance, you should be able to understand the borrower directly financed from investor or lender, right? So the financial assets are often traded in the primary market through a direct financial arrangements. Okay, but you will get more details as you move on in terms of direct finance versus indirect finance. So you will be able to see these details in the financial market. Okay, so if you see this financial market functions, right? So these financial markets, as you already know, the basic function of channeling funds from surplus entities to deficit entities, also promote economic efficiency by producing an efficient allocation of capital, which increases production. This is related to allocation of capital. So when the financial markets are there, whoever who has a brilliant product idea, brilliant project proposal, can bring his proposal and request markets to fund its operations. So thereby markets would factor how efficient the proposal is, right? And make the limited resources available with the market efficiently being channeled. If that proposal is not necessarily brilliant, then the market would penalize such proposals by asking higher interest rates, or for that matter, higher cost for the borrower. So this is how it's work. So the market facilitate economic efficiency by producing efficient allocation of capital. So you probably know in most cases when it comes to allocating scarce resources, sometimes you might see if you've been allowed to some parties to be given priority, you probably see based on your kith and kin, your relationship, your affiliations, these resources being shared, not necessarily by the merits of the business proposal or the project proposal at hand, right? But when it comes to financial markets, they don't care whether it's a relation or a kith and kin, or for that matter, you have any affiliation. No. So if the proposal is worthy of merit, they would look at it and they would give you a priority. So the financial market essentially facilitate economic efficiency to bring economic resources being productively used through efficient capital allocation. Okay. So then it's directly improve well-being of consumers. Well-being of consumers by allowing them to time purchases better. Okay. So what is this time purchases better? So now you all are studying, right? So you all are working. You all wanted to have a career. You all wanted to have a better life. So now itself you wanted to have a motor vehicle. So you wanted to save for this motor vehicle. So if you start from this month's salary, think how many years of saving you require to purchase a good motor vehicle, right? Similarly, you want to build a house. If you start on your own to save your funds today, by the time you build a house, you must be retiring from your working life. So it's like this. So when you really build a house where you have put tiling and all modern amenities, but you would not be able to walk on those tiles. You are old by that time. You will slip and fall. You would not be able to kind of, climb these stairs, but you have built. But what this time purchase better facilitates is today itself, you can get the resources to build a house from the financial market. Today itself, you can buy a motor vehicle to drive by having financial market facilitation, rather than waiting till you finish your career, like your retirement age, where your eyesight is poor. You will not be able to drive. Okay, so the market improves the well-being of consumers by facilitating these resources that you require today, right? And then over a period of time, you make payments to kind of, service these obligations that you have created. So if there's no financial market, this would be challenging. You have to go behind your relatives who has excess resources, or for that matter, you probably require many other forms of difficulties. But financial markets provide you with the facility where it facilitates your well-being by time purchases better. So you, instead of waiting till your entire working life, you are self-plan today and build. And similarly, this is yourself. For an institution, for an economy, for a country, they require infrastructure. You want highways today, or you wait till another 20 years to build a highway. Think, I mean, this is how the resource constraints comes in, right? So you have to get these facilitations fast. So how you facilitate this? By facilitating resources through financial market. So this is also a function of financial market. So the financial markets enables you to have efficient resource allocation in the form of efficient allocation of capital, thereby promotes economic efficiency, and also it improves the well-being of consumers by allowing them to purchase time better, right? So these are very important functions of financial markets. Any questions? If you have questions, you can just pause it to me so I can clarify as I move on with the discussion. Right. So then you see a basic kind of a structure of a financial market in terms of direct finance as well as indirect finance. This is flow of funds through the financial system. So you see, you have already learned about direct finance. So you have savers in the one side, the borrowers. Okay, so one side you have surplus entities, then the other side you have shortage entities. So lenders, savers, borrowers, spenders, this is how you look at this in the financial market. So if you put them from a broader sense, it's households, businesses, governments, foreign institutions, or foreign individuals. So these are savers. Similarly, they become borrowers from the other side of the equation. So each and every household, they might have savings, but at the same time, they might also require from a different perspective to have the borrowings for facilitating their economic needs. So in the financial markets, if it is direct, so the savers channel their funds to the financial market, where financial market produce the financial assets, So the savers directly buy those from the financial market itself. So the issuance of a debenture, issuance of a stock, that's how it works. So they channel these funds to them, and these funds being channeled to the borrower. So let's say government. So the government wants funds to spend for COVID-19 related health expenditure. So they wanted to borrow from the people in the economy. So let's say households. They also borrow from businesses, foreign investors, right? So these people invest in government issued treasury bonds or treasury bills, and these funds being channeled by the government for the purposes of COVID related health expenses. If not for the election related expenditure now. So this is not different. So it's a direct channeling of savers funds to the borrowers. So it's a direct financing arrangement in the financial market. But how's the indirect finance work? So the savers channel their funds not directly to the borrower, but to the financial intermediary, banks. Right? So when they channel these funds to the financial intermediary fund them through loan arrangements at prime lending rate. So prime lending rate is the rate at which most trustworthy customer borrows from the bank. But you and me will not get that rate. So we have to borrow at a different lending rate. So there are various type of lending rates there. These financial intermediaries, banks, extend these funds to these borrowers. So the borrowers get their economic activities or the resources channeled through the indirect finance channel, where the financial intermediary exists between the saver and the borrower. So financial intermediary again, he may come and invest in financial markets in the direct finance also. It's not only the savers channel in the direct finance to borrowers, but even financial intermediaries, when they have all these savers bringing their assets, because these savers are not competent enough, their capacity to kind of go through the contracts in the direct financial arrangement is difficult for them. So what they do is they basically go for a simple saving and purchase that from a financial intermediary bank. So the bank get these funds and they come to, because they have a investment arm, expertise in terms of legal profession, market practitioners, and analysts to analyze this behavior of financial assets and things like that. So they bring these savings and other resources that they have to the direct financial market, financial assets, and invest. So that's why you see the lenders or the savers channel these funds to financial intermediaries, and these funds again comes to the direct finance, that's the financial markets, and then channel to the borrowers. Or the financial intermediary directly lend to the borrowers. So the indirect finance and direct finance is the form through which these funds being channeled from surpluses to the shortage entities in an economy. So this get often either in a very clean direct basis, or very clean indirect basis, or in an exchange basis, where the direct channel also being used by financial intermediaries to come and kind of provide the funds to the borrowers. So please remember, this is how all around the world markets work. In any form you put it, ultimately you can fit things into this. So this is a very clear in terms of a broader chart for you to understand. Okay, so any questions? Right, so you can move on. So when you see these structures of financial markets, we have now seen direct and indirect. So in this sense, the debt and equity markets, okay. So when you say debt is often the debt instruments, debt securities market, like bonds, then you see bills, debentures that we call, it's a debt market. And even from a broader sense, people also put loans also into the debt category. So debt and equity market, equity is ownership, that is the stocks. So you exchange your investments to the institution in exchange of the ownership of that institution. If you buy a stock, that means you are an owner, right? So when you see a debt instrument in the debt market, you often see a time period by which the debt instrument is maturing. So if it is a bond, 5 years, bond 10 years, a bill either 3 months, 6 months, or 1 year. In Sri Lanka, 91 day, 182 day, 364 day. Often bills are within 1 year horizon, but there are 1 or 2 countries in the world, they have bills for 18 months also, that is 1.5 years. But generally, debt instruments have a maturity time period at which these instruments become mature. So that will be the timeline at which you will have to get your principal investment. Okay. So when you talk about equity, there is no maturity. Equity means your stock investments. So if you wanted to get rid of that, you can sell it in the secondary market. Fine. Even debt instrument, you can sell it in the secondary market. So whoever buys, who gets that debt instrument, but still that maturity exists. But in the case of equities, stocks, there is no timeline for maturity. What you are simply seeing is, in the case of equities or stocks, you receive dividends. That is the share of your profit being distributed by the financial, not the financial agency, the institution concerned. If you have invested in a diversified conglomerate or a bank, that bank would pay you dividends based on their earnings. So you are a recipient of dividends if you are an equity investor, right? So if you are a debt instrument owner, or you have invested in debt securities, you have a maturity period, but in the interim you will be receiving coupons. Okay, but there are different type of returns that you can discuss under these financial assets. But when you talk about these financial structures, debt and equity market is also very important. You can see the difference. In debt market you see a maturity, in the equity market you see the dividends being discussed. And then you see primary and secondary market. You can read the supplement that we have already shared with you, that also details out. So what's the primary market? Okay, so you see a primary market where investment bank underwrite securities in primary market. Apart from what I said earlier, where you see issuer, or for that matter, the borrower directly exists in primary market, right? You see in primary market, investment banks underwrite. Underwrite means they confirm with the issuer in the event there is no subscription, they will subscribe to the amount that they have offered. This may be full or this may be partial. That depends on the agreement that you are entering. So that means if there is a 100 billion issuance, 100 billion rupees bond issuance, right? Or for that matter, a 10 billion rupees stock issuance, right? Market investors have invested 8 billion. There's a balance of 2 billion left. So the investment banks who manage this underwrites to the government, or for that matter, this company who issued stocks, that they will buy the balance 2 billion of that 10 billion, the stocks that they have issued. So it's underwriting. So they commit themselves to buy any unsubscribed portion. But often you find the market issuances get oversubscribed. So that means you have more than what is you are offering. So then you have to distribute. So you don't get necessarily underwriters being called to fund. But this underwriting has a cost, right? So you have to make a arrangement to pay those underwriting costs when you are having an underwriting facility. But that's the kind of, a feature that you see in a primary market. But when you see a secondary market, you see brokers or dealers. They are, again, they don't buy for themselves. Even if they buy, they would trade it immediately. So there's no underwriters. So they basically exchange for a commission. Okay, so in the secondary market, you find these brokers and dealers, they exchange for commissions, whatever the financial assets, and they are sell it to the a new investor from existing investor, or then of course the exchange between investors. So these are the kind of features that you see in financial markets, and you can read the supplement to have little more details in terms of these concepts. Any questions? Right. Okay. So then also you see in the financial markets, we are discussing about the financial markets. You have exchanges and OTC markets, right? So you see exchanges, as I was telling, stock exchanges. Then you see commodity exchanges. Commodities like petroleum, then you see minerals. These also exchange, but not necessarily a financial market then, but then these are linked with financial markets because these commodities also exchange for foreign exchange, or for that matter, that has a payment leg. So you can have all these transactions and financial products of derivatives that we are just touching upon. We don't get into derivatives and study. That's not the purpose of this program. But these were there. But what you are simply seeing is you see exchanges where you see directly buyers and sellers exchange their financial assets through screen-based arrangements. Okay, but at the same time, you find OTC, over the counter, over the table, right? This is OTC. So foreign exchange markets are always, and most cases, functions through OTC arrangements. You probably not find foreign exchange markets for functions through electronic pricing screen. But there are some facilitation, but generally it's I should not say always, it's generally it's exchanged through OTC markets. Then you see big ticket, that means big volume transactions in financial assets markets also functions through OTC. I say big ticket and big volume. If you simply see a huge buying interest, let's say in a stock market, or for that matter in the bond market, when there's a big buying requirement, what happens to the existing sellers is that they can easily increase the prices because there's a big demand for buying. So higher the demand, what you can simply see is the demand curve shift to the right. So it's a supply and demand analysis that you all know, shift up. So when it shift up, the prices increases. So if you really come to know there's a big demand, this happens in any financial market. So what happens is, in such circumstances, instead of average transactions, the parties who wants to buy, they don't come and openly disclose all their buying demand. So they probably discuss that with a seller who wants to sell a big volume. The opposite of that demand is the seller. If the seller is also wanted to sell big amount, what happen is the prices decline. People start realizing, oh, there's a big supply. It's like a orange market, banana market. It's like mango market. So if you go to Sunday's mango market, you probably see if a huge amount of mango supply, prices declines. Similarly, if you find there's a huge demand for mangoes, the prices increase. So it is same. So OTC facilitate the big ticket investors, okay, or for that matter, high credit worthy investors or very influential investors, because they think he makes investment decisions very profoundly, so he would not make mistakes and he carries a goodwill, right? So they don't necessarily come and buy straightforwardly. So you don't necessarily know the transaction, who is doing that also, until that's been revealed in financial markets. But what happens is such details may drive the prices unnecessarily and not in line with the fundamentals of attached to that instrument. So what the OTC market facilitate is they take out this noise, this volatility in transaction by bringing in the parties to the transaction over the table and exchange it, and then within matter of the regulatory requirements, they announce them in the market, so the market come to know after the transactions the big parcel has been changed hands. So that is OTC. Exchange, you can always see the buying, selling. It's the standard volumes they trade. Okay. So then you see money and capital markets. There's a definition again in the supplementary note that you got it just now. So you see money market that deals in short-term financial instruments, debt instruments for that matter. You can call it, it's a short-term market. Okay. Capital markets deal in long-term debt and equity instruments. So it's more than 1 year often. So the capital market, it's based on the duration. Capital market and the money market differs in terms of duration. 1 year or longer, it's capital. 1 year or less, it's money market. So this is a broader definition that you find in any textbook or any market for that matter. Any question before I move on to the next section? Sorry. Right. So then you see a broader classification of money market versus capital market in terms of different features that you come across in financial market. So this is a very simple but very straightforward explanation of the different features between money market and capital markets. This is very important. I mean, if you can get a glance and kind of understanding of this, you would never miss the kind of difference between money and capital market. So if you take the duration, the time period, as you already know, a money market is for a short term or short time period, 1 year or less in most cases. The capital market is for long period of time, so often more than 1 year. So nature of funds exchange in money markets, okay, often supply of funds, if not working capital requirements. So not necessarily permanent capital or permanent funding requirements. So it's like the kind of a period-based funding requirements that you see exchange in money markets. In the capital market, you find fixed capital requirements, so supply funds again, but for a longer duration, right? So when you wanted to expand your factory or the project base, so you need longer term duration funds. So then you see the financial markets would facilitate capital market financial arrangements for such requirements. So the instruments in money markets are often treasury bills. Very popular one is treasury bills, then you see commercial paper, certificate of deposits, and things like that. But in capital market, you often find the shares, that is stocks that we were talking, debentures, that's a private issued bonds, and treasury bonds for that matter. So these are very long term, sometimes up to 50 years, up to 30 years. So this is a long term financial assets. So amount of instruments. Okay, so each single instrument of large amount in the money market, because money market often you find participants are also institutions and high net worth individuals, right? Not necessarily a simple investor. So you find large amount transactions are quite feasible and reasonably normal in money market. In the capital market, small timers also there, but you can't necessarily conclude there are no big time investors. Sometimes in the capital market, the investors are much bigger and larger than money market for that matter. So you don't need to kind of precisely go by small amount here. You can still find small time investors exist in capital markets, not necessarily in money market, because money market could be volatile very often. Okay, so institutions in these markets are also, you find often, I mean, not different much, but then you see insurance companies, pension funds, long-term mortgage-related agencies, they work in capital markets because their liabilities are longer duration than money market institutions. Okay, so risk in terms of capital market is higher because the time duration is greater. So longer the duration, greater the risk. You can see if it is 10 years from now, you are not sure what would be the circumstances, what would be the changes the economy and yourself would have compared to 1 month from now. 1 month from now, you are reasonably certain your hair would not become gray or you will not become excessive in weight. No. But 10 years from now, it's very difficult for you to say. Similarly, when it comes to the risk, the capital market risk is greater because you look at a longer duration from now, right? Then the transactions in the capital markets are through formal arrangements, whereas in the money market it could be over the phone or normal formal place. No formal place could be also possible because these are already established agencies that transact often in money market. So brokers, okay, in the capital market you can see these brokers exist, dealers exist, but in the money market sometimes you don't find these parties. Basic role is liquidity adjustment in money market because you don't have a big funding for longer duration, like it is temporary liquidity facilitation in the form of overnight financing. Sometimes the overnight is today you borrow, tomorrow you settle, so overnight. So that's a money market kind of feature. But when you look at capital markets, it's for long term capital related work. Okay, so it's a kind of, you know, duration wise very lengthy. Okay, so relation with monetary authority, central bank, money markets are closely and directly linked with central banks because central banks also facilitate short-term financing through their operations, and we will be learning these things when the central bank section comes in. So in the capital market field, central banks influence, okay, but mainly indirectly and through the money market itself. They are not necessarily a big participant to some extent in capital markets, but in today's exceptional circumstances like COVID or financial crisis, like central banks also participate in capital markets. So market regulation. In the money market, often the commercial banks are there. They are mostly regulated. And in the capital markets, different various type of agencies are there, so their regulation is not necessarily that strong like the commercial banks in money markets. So this is a kind of broader picture that you can easily try to recognize financial market in terms of money market and capital market with their different features. But very simply, what you have to recognize is the money market is a market for shorter duration financial assets, whereas capital market is for longer duration financial assets. So that sets the difference in terms of how these markets operate. And in the market, you find the instruments also. So money market instruments, as I said, treasury bills are often the main financial instruments. You don't worry about the amounts here, because these amounts are US financial market. It's not necessarily important for us to remember because these volumes also changes in recent times. What you're simply seeing is the instrument, mainly the treasury bills. Then you see commercial paper and certificate of deposits. These are quite familiar instruments in money markets. But in the capital markets, you find bonds, stocks. Okay, so these are the ones often dominates the capital markets. And you probably see loans also there, because loans also part and parcel of long-term financial assets in most of the markets. So these instruments is also kind of give you a feeling how these markets work, how this market operates, right? So you can get a kind of a feel from these assets in these markets. And then you see internationalization of these financial markets. Before I move into this, any questions that you all have? If you have any questions, just please feel free to kind of pass those text so it's visible in the screen, so I can also follow up as I discuss in the discussion. Right. So you see so-called internationalization of financial markets. This is also very important in the sense you already know that the markets are integrated, and very especially today the markets are investing across borders. So you don't restrict your investments to the four walls of your country. No. So it goes beyond the territories, boundaries of countries and economies, and invest. So you find this financial market facilitate different financial assets through internationalization. So you find foreign bonds. So what the foreign bond is, it's sold in a foreign country and denominated in that country's currency. Okay, so if we have issued something in India in Indian rupees, it's a foreign bond. Institution, right, which is foreign to that economy. For India, a Sri Lankan institution is foreign to that economy. Okay, so you issue in India, that's a foreign country, and denominated in Indian rupees, it's a foreign bond for the institution concerned, right? Similarly, what you simply see here is, if a US firm, right, registered in US, issues a bond in Japan, in Japanese yen, right, it's a foreign bond for that institution concerned, right? So then you see Euro bonds. So bond denominated in a currency other than that of the country in which it is sold. Euro bonds is the most popular and most sought after financial asset, often the other countries issue. For instance, Sri Lanka issues international sovereign bond. This is called Euro bond issuances by government of Sri Lanka. Right? So these bonds are denominated in US dollar. Okay. So this bond is denominated in a currency other than that of the country in which it is sold. This is not sold in US. Please remember, US dollar denominated international sovereign bond, which is marketed in US. There's no problem with that, but sold in other countries by the government of Sri Lanka and invested by investors across the globe, Asian, European, and US. Okay, but US investors invest through their desk in elsewhere, and this been recorded and kept in the exchanges in other countries. So it's a Euro bond. Okay, so this is another very important element. And then you see Euro currencies. Okay, so Euro currencies is nothing but foreign currencies deposited in banks outside the home country. If US dollar is deposited outside US, it's a Euro currency for the rest of the kind of considerations that we have. Okay, so it's not the Euro currencies defined as so-called currency Euro. No. So what you have to understand here is foreign currencies deposited in banks outside the home country. Okay, so for easy understanding, instead of currencies, they call it Euro dollars when US dollars deposited in foreign banks outside the US or in foreign branches of US banks. So Euro currencies is the generic, but make it more specific, they call it Euro dollars. So US banks or US dollars deposited in foreign banks outside US or branches of US banks outside US. So US banks are here, Citibank is in Sri Lanka, Citibank is in Hong Kong, Citibank is everywhere. And other US banks are there. So US dollar deposits by anybody outside US or in the branches of US banks operating outside US is considered as Euro dollars. Please read these things. It's not necessarily something rocket science, but it's very simple. You don't need to confuse, but take a kind of a breathe and kind of a slowly read and try to understand slowly. It's very straightforward. Okay. So then you see internationalization of financial markets also has the element called world stock markets. Today, the investments in stocks do not necessarily restrict to your stock market, let's say Colombo Stock Exchange for that matter. No. So you can invest in rest of the world. So when you invest in rest of the world, it's basically a world stock market. So it's everywhere. So this helped to finance even governments' financing requirements. So it's not only listed in Sri Lanka, but you list in outside the world. Outside your country, outside the world is not right. So it is like you list outside Sri Lanka, so you list in other countries. So it's trade in those exchanges. So it's a world stock market. So Sri Lankan companies, some of them have listed in different countries. So those stocks exchange in those countries and ultimately bring resources to your economy. I don't want to name few agencies they do these transactions outside Sri Lanka and listed in those stock markets. So there are kind of possibilities through which you channel your required resources. Any questions? Right. So let's see the next element. Then of course what you are simply looking at is, now you are looking into functions of financial intermediaries. That is indirect finance. You see, so when you see indirect finance, you always see the existence of a financial intermediary, mainly the banks. So they channel funds from savers to borrowers. So what this basically facilitate is, it lower transaction cost. Okay, financial intermediaries funding is lower in transaction cost, and you probably know that if you wanted to plan, you wanted to design, you wanted to go through directly the rules and regulations and related laws and related list and requirement, related infrastructure for direct financing arrangement, it's costly. You yourself trying to fund something, but you had to go through all these processes, because this is market, well defined regulations, transparent pricing, there are method systems, there are laws to facilitate customers, or in the sense investor protection arrangements. So then what happens if you try to do on your own? It is costly. But if you go through a bank already established these things in its operations. So they have many ways of reducing the cost. So the indirect finance, financial intermediary based finance, the main and foremost advantage is lower transaction cost. So time and money spent in carrying out financial transaction is substantively lower if you go through the financial intermediaries. That's why everybody tries to make use of a bank for their financing requirements. Even if you have excess, you have a surplus, you try to go and deposit them or put in a kind of a financial investment with a financial intermediary. So that's much more straightforward and easy than going through all the other regulatory requirements and complexities to some extent in terms of directly try to kind of invest. These are kind of features that you see that made indirect finance is very popular among the whole financial structure that we are talking. So if you look at the financial structure, in most cases, in most countries, about 80% of the entire financial arrangement is coming through indirect finance, not through direct finance. Although we are moving in that direction, it's very slow, and the indirect finance also expanding much faster. So the lower transaction cost is the main driver or the attractiveness of indirect finance that get all these stakeholders to glue with financial intermediaries in terms of savings, in terms of borrowings, often you can see. So what it facilitates time and money spent in carrying out financial transaction is economies of scale. So the banks do not keep one person or a transaction related one party for a transaction. No, they have established units, legal department, listing department, corporate department, okay, analyst department. So it's a pool of capable resources pooled in one source. That's the financial intermediary here, and they have so-called expertise. So the expertise that they have would help them to provide their services at much more competitive rate than you yourself try to establish all that and try to carry out a direct finance. So there's scale economies. So if you increase the number of units of production, average cost reduces, average cost diminishes. So this is what scale of economics or the economies of scale describes. So financial intermediaries do not only transact for one particular customer. They have thousands of customers, thousands of financial assets, and they have established expertise within their institution itself, and that facilitate to bring down the overall cost of transactions. And then they have liquidity services. They themselves buy and sell. So if somebody wants to sell, they can basically provide the financial assets to the financial intermediary and get them liquidated. That means cashed. Similarly, when the banks are transacting, even if you have a fixed deposit for that matter, if you want immediately finances, you can convert that fixed deposits to a normal deposits and get the cash. Of course, you would have differences in interest rates, but ultimately it serves your liquidity purpose. The financial intermediaries or the indirect finance has those features. So that helps reduce the transaction cost. And that remains the main driver why indirect finance is popular. Then it reduces the exposure for investors to risks. Indirect finance reduces you directly dealing with the borrower. And you might not necessarily know who's the borrower is and his intentions of investments. He might give you a good proposal, but you are not capable enough to go through that. But financial intermediary, right? They have capacity, they have capability, they have resources to evaluate these proposals in detail and assess the risk of that proposal itself. And they do not necessarily meet the saver to the borrower. No, you have a contract with financial intermediary has a contract with the borrower. So we will get into these details as we continue our discussion in our next class. So I will stop at this point and we will have another new presentation and new area for discussion next week. But keep these discussions again revised with the lecture notes and the supplement that I have given, and also as I was requesting you all to follow up with financial press. So that would help you to further the knowledge base that you have in terms of this area of discussion. This is very easily kind of, identifiable in terms of financial press. If you read through, there are a lot of materials available and you can familiar with some of these stuff. Any questions that you have before we conclude our discussion today? Right. So it seems that you generally have a greater kind of a picture on what we are discussing now. So I will ask IBSL to once again share these slides. If not, you yourself can write it to them. They will share these details if you are having difficulty in accessing this material. But my understanding is these details would be much more clearer. So you probably be able to have these details as you discuss with them. So there are some requests for me to share my email address, but I prefer you can send these discussions related whatever details in the class discussion itself, because often the work environment I get quite engaged. So probably be ideal in terms of sharing any materials through the class arrangement itself than sending any personal mails and following up, because that would make my life also a bit difficult. Okay. So supplementary note also, as per the IBSL, it seems it's shared, but I will ask them to share them again for your easy reference. So if you do not have any further question, I really kind of ask you all to go through the materials and be prepared with discussions and other details. Right. So with that, we can conclude and stay safe, and we'll meet next week. Thank you.